A backtest can lie to you, and most backtests do. Not because the data is wrong, but because the process contains traps that create false confidence in plans that have no real edge. And traders who fall into these traps enter live markets believing they have proven systems only to watch reality destroy what their backtests promised. Trap 1 is curve fitting, which happens when you keep adjusting your rules until they perfectly match what already happened in the data, essentially memorizing the past rather than finding patterns that repeat. And the telltale sign is a backtest that looks too good to be true. Because it is too good to be true. Optimized for history in ways that won't work going forward. The emotional driver of curve fitting is the need to see a winning backtest, because you've already decided you want this plan to work. So you keep tweaking parameters until the equity curve slopes upward, convincing yourself each adjustment is legitimate improvement, when really you're just teaching your system to trade the past perfectly while remaining useless for the future. Trap 2 is survivorship bias, which happens when you only test on assets that exist today while ignoring all the assets that failed, were delisted, or went bankrupt during your test period, creating a sample that's pre-filtered for winners and making any strategy look better than it actually was. If you backtest a stock strategy on today's S&P 500 companies going back 10 years, you're only testing companies that survived 10 years, missing all the companies that failed during that period and would have triggered losing trades your backtest never sees. Trap 3 is ignoring transaction costs, which sounds minor until you realize that slippage and commissions can flip a profitable backtest into a losing live strategy, especially for systems that trade frequently where small costs per trade compound into massive drag over hundreds of trades. A strategy that shows 10% annual return in backtest might show negative returns in live trading once you add realistic slippage on entries and exits, plus commissions on every trade. And the trader who ignored these costs in testing watches, confused as their proven system bleeds money in practice. Trap 4 is testing in only one market regime, which happens when your backtest data only covers bull markets, or only covers low volatility periods, or only covers one type of market behavior, creating edge that only exists in conditions that don't always exist. A system backtested from 2012 to 2019 looks amazing, because that period was almost entirely bullish with low volatility. But that same system tested through 2008 or 2020 or 2022 might show devastating drawdowns that revealed the edge was regime-dependent, not universally valid. Trap 5 is insufficient sample size, which happens when you draw conclusions from too few trades and mistake luck for edge, because 20 winning trades in a row could be genuine edge or could be random chance, and you can't tell the difference without hundreds of trades across varied conditions. The emotional driver of insufficient sample size is impatience combined with confirmation bias. You want your system to work. You see early positive results. You conclude it works and stop testing, never discovering that those early results were noise that would have regressed to unprofitable over proper sample size. The painful reality is that falling into any of these traps produces the same outcome. You enter live trading with false confidence. You experience losses you didn't expect. You conclude that backtesting doesn't work when really your backtest was flawed, and you either abandon backtesting entirely or repeat the same mistakes on your next system. Avoiding these traps requires honesty that most traders resist. Keeping rules simple enough that curve fitting becomes obvious. Using complete data sets that include failures. Adding pessimistic transaction costs that exceed what you expect. Testing across multiple market regimes, including the ones that scare you. And gathering enough trades that luck can't masquerade as edge. Your implementation. Audit your current backtest for each of these 5 traps. Ask honestly whether you've optimized too aggressively, whether your data includes failures, whether costs are realistic, whether you've tested bear markets, and whether your sample size actually proves anything, because a flawed backtest is worse than no backtest, since it creates confidence that reality will destroy.